year 2022 has been a challenging year for investors and the stock market. Whether a person is primarily in equities or, for that matter, primarily in bonds or some mixture, in all cases, it's been a challenging year. In particular, it was a down market for the first 6 months of the year, and you could even say for the first 9 months of the year. But since about the 1st of October, the market has begun to show some strength. I would not call it a rally, but I would say that it is trying to show some strength. The question is, in investors' minds, what is going to happen in 2023? People are looking out into this next year. I will cover that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 13, 2022. I want to begin with a clip, some segments from an interview that Melissa Lee on CNBC did with Morgan Stanley's Mike Wilson, their chief investment officer. I'm playing it because it makes sense to me. It's really what I was thinking. I don't like to predict what's going to happen tomorrow or next month or next year, but she pins him down pretty hard to say, tell us what you think. And of course, they do research, they have an opinion. It may not at all come true the way Mike Wilson lays it out, but he does have some facts that he relies on. And so I'm going to play this and then I'm going to comment on it. So here is the interview with Melissa Lee and Mike Wilson.
Our next guest sees a lot of two-way risk in the market. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO. Mike, it's always good to see you.
Thanks for having me.
Two-way risk sounds like markets up, markets down. What do you mean by that?
Well, it's not getting any easier. Okay, let's put it that way. I mean, I think the first half of this year is, fairly simple if you just were bearish and kind of held that position. And then, we've had two major, tactical rallies since June, the first one, and then, of course, one in October. This one actually has better breadth, which is kind of interesting. And so I do think we're closer to the end. I mean, we don't know when the Fed's going to pause. We think it's January. I think they do 50 in December, 25 in January, and that's it. Okay, that's ahead of where the market is. And the market's trying to pre-trade that, kind of like it did this summer. Now, we thought it was premature this summer to get in front of that. This time, we actually think there's validity to that. The question is, what are you going to pay for this thing if you think earnings are going to be really disappointing next year, which is our core view? So, we're trying to have our cake and eat it too. We like to do that, right? So we're having a tactical rally now. I kind of agree with Steve. We probably got some upward bias into year end, but ultimately the bear market's not over, and we got significantly lower lows if our earnings forecast is correct.
Yeah. So 2023, your price targets are out. 3,600 is your bear case, 3,900 is the base, and 4,200 is the bull case. What's the rate expectation backdrop to these cases?
Yeah. So it's probably somewhere between 275, 3 if it's a recession to maybe 4 1/4 if there's a reacceleration in the back half of the year. I'd probably split the difference. I'd probably say it's 3 1/4, something like that. Look, to me, it's not about the year-end targets. It's about the path. Right? I mean, nobody cares about what's going to happen in 12 months. They need to deal with the next 3 to 6 months. And that's where we actually think there's significant downside. So while 3,900 sounds like, that sounds like a really boring 6 month, no, this is going to be challenging.
It's a wild ride.
It's going to be a wild ride. And there's going to be lots to do.
I think it was October 14th on a Friday is when you came out tactically bullish, 15% rally. It's exactly what happened. I mean, so you nailed that. But 3,600 as a bear case does not seem catastrophic to me, given the backdrop that we've talked about for a while. So I guess what are your earnings number, then what multiple putting on the back of that?
Yeah, but remember, 3,600 is year-end 2023. So our bear case path is 3,000. So, and look, the range we've given people is you should expect a S&P between 3,000 and 3,300 sometime in probably the first 4 months of the year. That's when we think the deceleration on the revisions on the earnings side will kind of reach its crescendo.
I'm sorry to interrupt. 3,000 to 3,300 in the first 4 months of the year. In which case? In any case?
That's the range. I mean, we can't be that precise.
Right. But still.
Yeah, that's a big drop.
That's a big drop.
Correct.
Yeah. Okay.
And that will be driven really by the earnings revisions to the downside, which is the second half of our thesis for this year, which is the ice part of the fire and ice. So, I still think this tactical rally has legs into year end, notwithstanding all the noise we're going to get in the next 2 weeks, simply because of the liquidity at year end and people chasing, and we have to deal with that. So this is not a time to sell everything and run for the hills, because that's probably not until the earnings come down in January, February.
Well, it's interesting. So, but you do seem like you're saying by March or April or May of next year, the bottom is in.
I think so, yeah.
And what tells you the bottom is in? Is it the revision story, or is it really the combination of the Fed has signaled?
So there's really two things, Tim. I mean, I think you have to really take a view on. The first is, okay, first, are we going to get those revisions? Are you going to get price to give you a fat pitch? Because that's the one thing that hasn't happened yet this year. Even though June, prices got low, and October they got low, the equity risk premium never really came in, right? It was all about rates. Now you need the equity risk premium to kind of blow out to tell you that there's a recession risk or a real earnings, degradation. But to get bullish, you then have to take a view, okay, are we in a 70s stagflation type scenario, which you're not going to get bullish? Or are you in the 1940s boom bust scenario that we've been kind of talking about, where there's a bust next year in earnings, but then 24, there's actually a reacceleration in earnings, okay? And that's our core view. So the market will figure that out, we think, sometime in the spring, maybe, early summer, and there'll be a good second half.
As I said, I try not to predict the future, and particularly the future of the stock market. But Mike Wilson had some views that I can identify with. When people give an optimistic view of the future and the future of the stock market, I agree with them. I also agree with those who give a pessimistic view. And you may say, Ben, how can you do both? As Mike Wilson pointed out, this is why it made so much sense to me, it depends on your time frame. He's talking about from now to the end of the year, it could be, a bullish rally to the end of the year. No one really knows, even Mike Wilson, but he gives that potential view. And then he talks about the April and May, sometime in the second quarter. He even mentions June. Sometime in the second quarter, he believes that January earnings are going to come out sometime in January or February, and that they will disappoint, that they're not what they have been expected to be, and that will drive the market on a downward trajectory to April or May. And then he uses some numbers, and these are S&P numbers, so most people are not familiar with those numbers. So I'll just convert those to percentages. Approximately, what he is saying is that he believes that the market will hit a low. He believes maybe the second quarter, we don't really know, but will hit a low, and he calls it from a range on the S&P of 3,000 to 3,300. What that means is that the market is likely to go down 15 to 25% more from where it is today. If you take that back to January of 2022, that would mean a drop in the market of about 30 to 40%. And he says that would probably be the worst point of the year. And from that point, he says it is likely to rally. And the rally he's talking about, the numbers he's using, tell me it is going to be a flat out rally to the end of the year. And with the S&P ending up in the 3,900 range. That's an estimate. His best case is 4,200. I think his worst case is 3,600. But it sounds like, and that makes sense to me, because that's what happens at bottoms. We're not at a bottom based on historical patterns. And so when you get to a bottom, it looks a certain way. If we truly get to a bottom, it will probably rally like it has in the past off of that bottom, and that first 3 to 6 months is going to be an excellent opportunity to make money. So what we do is we manage money. So our approach is tactical. So it is designed to minimize downside risk. We want to detect it as quickly as possible and prevent deep losses. So far, we've been successful at that. And then when the market turns, we want to get back in as soon as possible when it is the right time to get back in, not too early. This year showed how important that is, because there were a lot of head fakes, one of them in particular in March, a lot of head fakes that where people were sucked back into the market. They were used to buying the dip, and that didn't work anymore. Of course, they were also used to buying bonds to counter equity risk, and that didn't work. So this year produced a lot of surprises and disappointments, challenges. But as we look into 2023, I think what he says is right. It's going to be a rough ride. I think we're going to see quite a bit of up and quite a bit of down. That doesn't mean, and I would say this, we can check it at the end of the year, but it may not play out the way Mike Wilson says it will play out. It could be the reverse of that. We could see a rally from here and then a collapse. We could see a collapse in the rally and then another collapse. I mean, these things happen. So the market will surprise. It will usually do what you don't expect it will do or what Mike Wilson expects it will do. And so for us, if that happens, we will do what we always do, which is to manage money tactically, to take advantage of that kind of upside opportunity and get in as early as we can. And if you manage your own money, I'm just passing this on. You can do with it what you want, but I would be prepared for downside risk somewhere in 2023, and I would be prepared for some amazing upside opportunity, as he points out, because the market is going to be looking to 2024. Next, I want to play a brief clip from CNBC. Becky Quick is doing an interview with Jason Furman, who's he was chairman of the Council of Economic Advisors and several years ago, and he's now a professor of economics at Harvard. And he says that inflation is stubbornly high, and it will likely take continuing rate hikes from the Fed to get it down. And that we got here, you'll see this in the clip, we got here because of government policies and the Fed. And that's what she pointed out, Becky Quick pointed out. She said that was Milton Friedman's, professor of economics at University of Chicago. That was his phrase. It usually always goes back to Washington. And so anyway, take a listen to this and I'll comment afterwards.
Our next guest says that he expects a 50 basis point hike, and joining us is Jason Furman. Of course, he was the chairman of the White House Council of Economic Advisors under President Obama. He's now an economics professor at Harvard's Kennedy School of Government. And Jason, before we get to what the Fed's going to do, I want to back it up a little bit. I've been thinking an awful lot about inflation yesterday and today. Just everybody's blaming everybody else for it. You can say it's because of wages going up, that it's now really embedded into the economy and it's going to be hard to get rid of. We had a labor leader on earlier this morning who said it's big corporations' fault because they keep raising prices. But really, you got to go back to Milton Friedman. He says it's Washington. Inflation always originates and comes from Washington. And we spent trillions of dollars during COVID, and the Fed left rates low for a very long time. What else did we think was going to happen?
Yeah, I certainly agree with that diagnosis. And you always try to tell individual stories around inflation. But what inflation is upward pressure on everything. You see it on prices, you see it on wages. And when it comes to the private economy, by the way, it's not a morality play. If a business has a lot of customers that show up, they're going to raise their prices. If businesses really want to hire workers, workers are going to, increase their wages. That's just the way the economy functions. And then you have to ask, why is it doing that? Ultimately, it's really the government and ultimately the Fed's responsibility.
Okay, so you've heard Jason Furman, and what happens in this kind of environment is that the Fed will raise rates, and he says continue to raise rates. And here's the way this works. Normally, inflation, what they want to target is they want to get inflation down to the level where it is below interest rates, so that there is a net positive on interest rates, usually about a 2% spread. And that shows that people, that's just a normal balanced approach where the cost to borrow funds is about 2% below what they're paying. So think about this. If the Fed rate or the inflation rate is up in the 8% range or 8.7% range, and interest rates are at 3.25%, okay, that's about let's say that's a 5 percentage point spread. It needs to go, the inflation rate needs to come down about 7 points, 7%. That's, that's huge. And so, and as they do that, it's going to push, as they raise rates, it's of course going to push interest rates up and bond yields up. But to get those to invert, to come all the way back down with inflation so that interest rates are about 2 percentage points above that, I don't know where that will be. It could be that interest rates, that inflation will come down to, let's say, 4%, and that interest rates will be up around 6%. So if that's higher than they want, probably, but as long as they can get that 2% spread, I think that's what they're looking for. And they will, by doing that, will have wrung out a lot of emotion out of people and a lot of pain in the economy. That is called practically, I guess you'd say, a hard landing. So they don't want to do that, but I don't see any alternative. If they want to create the differential for interest rates to be higher than the rate of inflation. This article is from Forbes, and it says markets see a smaller Fed hike coming in December. This came out last week. So this week, the Fed meets, and they will announce their rate hike. It is assumed that the Fed is going to raise rates about 0.5%. That I would call that the consensus view. If they went all the way to 0.75%, it seems to me that's going to shock the markets. That won't be good. On the other hand, if they went 0.25 point, that could be enthusiasm for the markets. My guess is it'll be somewhere in the middle, like the 0.5%. This article from Bloomberg is interesting. It says the Fed's message that rates will stay on hold for some time clashes with 2023 rate cut bets. So the market is baking in, I'll show you a chart on this next. The market is baking in the assumption that there are going to be a pause. They will go up so high, they will pause rates at that level, and then they will start cutting. And that's what he refers to with 2023 rate cut bets. Chairman Powell's comments are, we are going to stay the course. I'm paraphrasing. We're going to stay the course, raise rates as long as we have to do it, as long and as high. He didn't say that, but that's what he meant. As high as we have to take them, we will do that to get inflation under control. And as I said earlier, what he means by that is get inflation down to about 2% below where the Fed rate is. So I don't know what that is. I just used an example of saying 6% and 4%, but that's speculation. Rates could go higher than 6%, but I do know that what they're targeting is a 2% spread. This is a chart that shows that, and it shows that what is sort of baked in is the assumption that rates are going to start coming down and into late the second half of 2023 or into the first half of 2024. We don't know that. I'm just saying that's baked in to the assumptions. I've shown this chart many times. I think it really tells an important story. As you internalize this, some of you are clients, so I'm saying it to you. Some of you, many of you are not our clients, so I'm saying it to you. Whoever you are, think about this. This is the Great Depression. We are nowhere close to that, but the Great Depression saw unemployment go to 25%. Most people, virtually everyone who had money in the stock market lost it all. Many lost everything else. If they had borrowed money, they lost their farms, their businesses, their homes. That was common. And that was the landscape of the Great Depression. So this chart shows not the economy, this shows the stock market. This is the Dow Industrial Average portrayed over about a 10-year period of time from 1929 to 1939. I think it tells a tremendous story. The story is that you can see on the far left of the chart, I circled it, the drop from the Dow Industrials from the top to the bottom. That drop represents about 88%. So if you were invested in the Dow Industrials at that time, which very few people were, they're usually invested in individual stocks, and the Dow lost 88% of its value. Now, that happened from 29 all the way down to 1932. So look what happens. In 1932, at the very bottom of my circle, you see a little tiny arrow pointing up and the number 4122. The Dow went all the way down to a number from almost 300 all the way down to 4122. That's a drop of 88%. The Dow went up, the top of that arrow touches about 75. So from 4122 to 75 is an increase of 78%. So the market, okay, this is 1932. Things are bad and getting worse, really bad. And the stock market, using the Dow as an indicator, the stock market goes up 78% in, what is that, 2 months? That's crazy. And then within the next year, it goes up another 100% in a few months. Have you ever heard of that? That's amazing. Nobody would say, let's invest in the stock market. But yet there was no better time. The excess had been wrung out of the system and then some. Nobody wanted to talk about the stock market unless it involved some colorful language. Nobody saw that as an opportunity that I can imagine. So we're emotional beings. So what happens is when markets come down, we've seen this market come down, not very much. The S&P has been down about 25%. At our worst point, we're down about 13%. And we did quite well in the first half of the year. But, you know, I'm not happy about that. But that's not a lot. Even 25% is not a lot. The thing that has made it challenging is that people thought they had protection in bonds and bond funds and bond ETFs. And of course, they did not. Sometimes bond funds dropped even further than the stocks did. But as the market comes down, here we are in a little micro version of the Great Depression, really a tiny little, unemployment's at 3.7%. I don't know of anybody, I've never heard of anybody losing their house. Maybe they have. I haven't heard of people who wanted to work that couldn't work, et cetera. And, you know, interest rates are still attractive. Yet I believe that, again, I'm going to kind of echo Mike Wilson's sentiment here, that this is the opportunity to take advantage of where we are right now. I see growth in 2023. I see this as a positive year. But as I said earlier, and as Mike Wilson said, I see it as a very negative year. So I think we will experience both. And so he goes on to say in his interview, you heard this, he said that this market, this type of market, this rocky ride that he sees coming in 2023 is ideal for tactical investing. That's what we do. We do tactical investing. But buy and hold investing, the opposite approach, just put your money in and leave it in there, I think there will be people who will be very happy at part of the time, and I think people will be very distressed when the market does what it typically does, is it wrings a lot of emotion out of people. When you look at this chart on the Great Depression, there's this period, the three arrows at the bottom, the little one, and then the two big ones. Well, little one, intermediate, and big. They 78%, 100%, 100%. But at the end, or in 1937, and beginning in 1937, I circled the second Great Depression. It began in 1937 and continued to 1938. That is a drop from the number where it was and where it went to, is a drop of about 50%. So when people all of a sudden had made all this money, half of it was gone again. So if people had any money to invest, by the time they got all the way out to 1938, 1939, it pretty much had wrung out all of the emotions that people had. We're nowhere close to that. But I see this as an opportunity, particularly with tactical investing. I have no idea what bonds are going to do, but I think tactical investing is going to be attractive, and we see it as a reason we're using our approach as a reason to be very optimistic about 2023. And I do agree with his comments. Chris produces my video, so I'm going to ask Chris now to play at the end of next year, at the end of 23, to play my remarks and to play Mike Wilson's remarks. And let's see how this works out. I think people are going to be very pleased if they use a tactical approach and they're good at it. And others, I think, will have, as he says, a very rocky ride, and they've got to figure out how they're going to deal with that. But 2023 will not look at all like 2022, I suspect. That's usually the way it works. This is the flow of funds report. It's dated December 7th, which is the most recent report, but the data actually ends on November 30th. So it's it's a week delay in reporting. So, by the time I'm producing this will be December 13th. And so it's a couple of weeks delayed from the actual data. But it shows that there are outflows, at least as of that time, of equity funds, 14 billion, and bond funds, conventional bond funds, outflows of 10 billion, and money market inflows of 47 billion. That's a lot. Probably tells you something, at least as of November 30th. You may be a religious person, or a very religious person, or you may not be. This is not a religious show, so I don't really bring that up very much. And so I'm going to bring a reference to the Bible. So wherever you come from, just bear with me on this. Do you know that in the Bible literally talks about crypto? I mean crypto. And I didn't realize it, but I'm going to show it to you. And then I'm going to show you what the word crypto really means in the original language. So here is this verse. It's found in the book of Revelation, the second chapter and the 17th verse. It says, "To the one who endures, I will give some of the hidden manna." Okay, that's interesting. What does that mean? I don't know what that means. So I looked up the word hidden. Now remember, back then, this goes back a couple of thousand years, so back then they wrote this book, the author, John, wrote this book in the ancient language of Greek, the original Greek, and that Greek is not the same Greek that's spoken today. It would be kind of similar to like Italian. Italian is spoken today. Back then, Latin was spoken. They're not the same language. There are some similarities, but they're different. So that Greek was a little bit different. But the word hidden, I looked that up. What does that mean? And it means crypto. And in Greek, the hard C comes with a K, because their C is not a hard sound. Crypto. The meaning of crypto, I looked that up. It meant to hide or conceal, to escape being found. Does that make sense? It sort of made sense to me. I just thought I would share a little tidbit of information since we've been talking about crypto lately. And I'll let you figure out what all that means to you. Thank you for watching. If you have questions or comments, leave them in the comment section below. I will try to answer them. and appreciate you watching. Thanks.